The first way to assure you're going to get the lowest interest rates when buying your first home is choosing the proper loan type, the proper loan product. For those that don't know, we have conventional loans, we have FHA, we have VA, and USDA. That's the hierarchy as far as the different loan types are concerned. To ensure that you're getting the best interest rates possible on your first home loan, this is what you need to know. If you do not have access to VA or USDA loan products or a loan type because of your income or your eligibility or where you're buying a home, then you're either going to go with the most common, FHA or conventional. If you're putting down as a down payment 10% or less, then you need to go with an FHA loan. If you are classified as a first-time home buyer, you've not had ownership interest or lived in a primary residence in the most recent 3 years, and number two, if your income is less than or equal to 80% of the area median income, then go conventional, do a conventional loan. And here's the deal on the conventional loan, and that caveat, you got to have a 620 middle score or higher. 620 middle score or higher on the conventional side, but trust and believe, pricing, the game has been fixed if you're a first-time home buyer at or beneath the 80% of the area median income. So that's the first step, the loan type. Second way to get the lowest interest rate possible here in 2023 is taking advantage of the seller-funded concessions, the seller buy-downs, either permanent buy-downs or temporary buy-downs. They're not a gimmick, they're not a hoax, they're a great tool to help deal with affordability. If you're someone that's more conservative, you want to use the seller-funded buy-down to permanently buy down your rate. For folks that are a little less conservative and understand or trust their lender and what the economic data is saying going forward and believe loan rates, interest rates are going to come down over the next 18 to 24 months, then I would strongly advise you doing a temporary buy down, because any of the interest that's paid up front that the seller is funding that's not used will be given back to you either in the form of a principal reduction, or in most cases that check is coming back to you to where you could do whatever. You could principally reduce the loan or pay off a bill or what have you. Permanent or temporary buy downs are the second way to get the lowest interest rate. If you're buying new construction, just keep it a buck with you. If the builder has a lender, you want to go with the builder's lender because they control the property. They're going to be given the concession. And that's how you see in some of these areas where they have low rates, because they're taking those monies and they're buying the rate down. Again, look at the difference between a temporary and permanent and weigh your options there. Don't let anybody fool you. Before I go to number three, temporary and permanent buy downs that are seller funded are a good deal if you could get it. For those that are buying pre-existing homes where you have it, it's really important to partner with the right team as far as your lender and your realtor, and have a realtor that has a track record and experience with negotiating to get seller concessions that you have options to use them with. Now, the first two strategies are based upon you actually having your down payment and maybe not all of your closing costs. So this doesn't necessarily work at its best when you are just barely trying to get in with no money's out of pocket. And I would strongly admonish you not to do that. This is with the assumption that folks have the down payment and most of the closing costs. And then therefore, when we have seller concessions or seller funded monies, then you have a lot of options that you could choose from, to lower that rate. The third and last way to get the best interest rates when purchasing your first home here in 2023 or beyond is by always having the best credit score possible. Once you've decided mentally to purchase a home, and I'll say you're 90 to 100 days out, 180 days, 90 to 180 days out from actually saying, hey, I want to be in my home, then you really need to get serious about your credit, especially if you think you have some challenges. And I would strongly advise for you to apply with your lender, okay? 2 reasons. You can actually find out what's going on. Your lender should have access to a soft inquiry where it's not going to hurt you. And then from there, you can actually be directed by that lender on what you need to do to prepare yourself to have the highest score possible while you're waiting. You're not waiting without a purpose. As I like to say, you're waiting and have a plan of action. So 90 to 100 days, 180 days out, you need to apply a complete application with all of the minimum documentation so that you can get that credit score as high as possible for when you're ready to pull the trigger. Once you're inside of 90 days, here's a couple of suggestions. Do not have any inquiries. All your inquiries and things of that nature need to be beyond 90 days, okay? Once you've gotten into the envelope, we need to kill all inquiries. Your revolving lines of credit as far as your utilization, your total pie, as well as individually, the best and highest scores are going to be, if you're carrying a balance, the balance does not exceed 3% of the available credit limit, for sure no more than 9%. So the range is 3 to 9% of the available credit limit. Last thing in that vein is with disputing. I'm seeing a lot of disputing on things that shouldn't be disputed. And the main one is this: charged off accounts. If it's been charged off, the creditor has written that debt off, okay? And it hurts you less and less the further you get away from it. If you want it removed, you need to have that creditor give you a 1099, and you're going to realize that as income. Again, those are things that you do outside of the envelope, day 91 to day 880 and beyond. You need to have all those things resolved so that once you're inside the envelope and you're moving forward, there's no inquiries, there's no disputed trade lines. Everything is settled, it's finalized, and your scores are what they are. In a few cases, you may be able to manipulate the score via what we call a rapid rescore with the paying down of revolving accounts and things of that nature. But again, guys, you want to do all that outside of that envelope to assure that once we get going, we don't have anything that slows us down so that you're able to get out and compete with confidence and get the best deal for you and your family. So to recap, loan type. Number 2, seller paid or seller funded permanent and temporary buy downs. And number 3, credit scores, having the best possible credit profile that you can have. So for more videos like this, watch this video right here, subscribe here, right? And hit the notification bell.